Hi, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. The commodity rally has continued here in 2022. Oil is up 16% year to date. European carbon allowances are up 15% year to date. U.S. natural gas up 45%. European gas up 12 to 15%, depending on the benchmark. There's a lot of read across into companies. ExxonMobil is up almost 30% year to date following their earnings yesterday. And one of the stocks under our coverage, Frontera, is also up 30% year to date. It happens to be a name we've got a focus idea on that Patricio Alvarez has looked after. Patricio, you put out a react on the company just the other day, and it's a company you've had a strong conviction call on for some time. So tell us what happened and tell us about your idea on the company.
Sure thing. Thanks, Rob. So for Frontera, we launched our focus idea, which is our high conviction call on the company's exploration potential back in July of this year, where we highlighted that the company was the only Latin American independent exploration and production company with exposure to one of the hottest exploration frontiers in the world at the moment, which is Guyana. So we saw an opportunity for the company there, given its high consolidated economic interest in the well that they've drilled. This well is called Kawa-1 well, and we got results yesterday, which although they are early results still, they're very encouraging, given that they've confirmed the presence of hydrocarbons across reservoirs interpreted to be analogous or comparable to major finds made by Apache and Total on Block 58 in Suriname, and also comparable to finds by Exxon on Stabroek in the Guyana side. So we are fairly optimistic about the ongoing testing of the well there, which will confirm the hydrocarbon grade and quality, and potentially the commercial viability of the discovery by the end of this month.
Thank you, Patricio. Will Hares, I want to bring you on as well. You also launched a new focus idea just earlier this week that also touches on the commodity complex. So tell us about your focus idea on Equinor and what investors should be looking for.
Yeah, thanks, Rob. So as Pat mentioned earlier, these focus ideas are sort of high conviction calls on companies or sectors or commodities. And mine that we've just launched is on Equinor. And for those that aren't familiar, Equinor is one of Europe's energy majors. It's majority shareholder by the Norwegian state. And most importantly, it is the number 2 gas supplier to Europe. And given this, we think that Equinor is uniquely positioned at the moment to capture value from the elevated gas benchmarks, as you mentioned, Rob, amid the continent's growing energy crisis. So my focus idea is really quite straightforward. It hinges on 3 main pillars. Number 1 is that Europe is experiencing this acute energy crisis, which has been particularly evident in natural gas. Number 2 is that Equinor is the second largest gas supplier to Europe after Russia's Gazprom. And number 3 is that we think that consensus European gas prices look too conservative and are discounting Equinor's potential value capture this year. And as such, we think Equinor can exceed consensus EBIT by 15% or more this year as a result. And I think just finally, given where we're seeing geopolitical risk, particularly at the moment in Europe with Russia amassing troops on Ukraine's border, we think it's hard to find a single company that acts as a better hedge to this level of geopolitical risk in Europe and potential Russian military adventurism than Equinor, given their position as one of Europe's key gas suppliers.
Very interesting, Will. Just a quick follow-up. What's your sense? Why is consensus so conservative right now on potential realized prices for Equinor? Is this something that generally takes place when you have big commodity movements when you look at the space?
So it's a good question. I personally think that it's just going to take some time for estimates to catch up. Keep in mind that we saw record high benchmarks for Dutch TTF and UK's NBP in December. These benchmarks remain very elevated. They are trading at 6 to 7 times higher than the equivalent in US Henry Hub benchmarks. So I think that there is a tendency for being conservative here from consensus estimates. I think they are underplaying it slightly. I mean, if you just look at year to date gas prices right now in Europe, they're averaging 25, $26 per MMBTU, very, very high, much higher than where consensus estimates are placing them. And while we expect them to normalize a bit throughout the year, given the pressures that we're seeing in Europe's energy crisis, we still expect to see record low gas storage by the end of the heating season, and as a result, we expect these conditions to extend deep into the year.
Thank you, Will. If you don't know our focus ideas, check out BI Focus Go on your Bloomberg terminal. This is where you'll find all of them compiled. And as Will and Patricio both mentioned, they're our highest conviction, most differentiated calls. They're essentially calls that diverge from where consensus is at. But with that in mind, we're going to switch gears and we're going to talk about another note that, Will, you helped to lead, which is we put together our top energy predictions for 2022. We put that out after our last bi-monthly call, and it contains a number of ideas that we think have a decent probability of happening here this year. So, Will, let me turn it over to you to give a high-level overview and also tell us about your contribution to the report.
Yeah, thanks, Rob. So this is a product that we've been doing for a few years now. It's a global product, so we bring in all of our energy analysts from different offices around the world, including New York and Hong Kong, and so we essentially come together and publish our best predictions for what we think is going to happen in global energy over the year, and at the end of the year we will review our predictions to assess them for accuracy. And some of the predictions that we have put out just recently and include our expectations that the U.S. energy majors valuation premium, which is quite substantial, will continue to persist over the European peers. Also, that Asia demand will fuel global LNG trade by a mid-single-digit percentage. And then there's some other ones but I don't want to steal anyone's thunder because I think they're going to expand on them. But I will expand on mine though, and mine is that the European oil majors are going to have a banner year for renewable power generation installation this year. We expect them to install more than 5 net gigawatts of capacity. This would be the biggest addition yet. And we think this is really just a reflection of the very gradually changing capital priorities for these companies. We are seeing increasing share of capex being deployed into transition businesses, namely renewable power in wind and solar, and particularly against this rising risk from a climate and sustainability standpoint, rising investor pressures at AGMs, particularly seen in Europe, and this renewable power lever that all of Europe's oil majors are pursuing is very clearly a foundational aspect of their energy transition strategies, and we expect that to be to show up in the numbers this year for net renewable power generation installed.
Just a quick follow-up, Will. I'd like to get you to gauge how the U.S. oil majors might compare to what we're going to see here in Europe. And I would note, if you look through ExxonMobil's investor presentation from yesterday, they did outline a net zero scenario where they showed 2030 and 2050, and they showed increasing capex potentially being allocated to what they described as low carbon solutions. How do you think the U.S. counterparts are going to line up against BP and Shell in line with your prediction for this year?
So I think for the U.S. majors, I'm not aware in depth of their strategies, but what I can say from the European standpoint is that the biggest lever that these companies have to achieve their full Scope 1 to Scope 3 net zero ambitions by 2050 is a change in product mix. This means moving gradually from producing oil to producing gas, which has relative lower carbon intensity, and eventually to producing electrons, renewable electrons, which have the lowest. And so a change in product mix will be absolutely key to achieving net zero ambitions. There are obviously other levers that can be pulled as well. For instance, operational efficiency, which is quite small in the overall scope. There's also divesting legacy higher carbon intensity assets, which we have already seen being started from several of these companies. But the key part will be a change in product mix to lower carbon intensity products, and I haven't seen much as far as strategy wise for the American majors that compares at all to what the European majors are doing on electric mobility, renewable power, battery storage, even biofuels.
Thank you, Will. So it sounds like a big divergence in at least the near-term strategy between what you're seeing in Europe versus what you're seeing in America, at least for now. Okay, I want to switch gears and talk about OPEC. Salih Yilmaz, our senior analyst covering OPEC, Aramco, and other things. We'll come back to today's OPEC meeting and talk oil macro here in a few minutes, but tell us about your call for 2022 that you contributed to our Outlook report that we put out just a week and a half ago.
Sure. Thanks, Rob. So my prediction is on the call on OPEC, which is essentially the number that we follow, which is the amount of crude oil that the world needs OPEC countries to produce. And our prediction is that this number will top 28 million barrels per day. And this number has been closer to 27, sometimes slightly lower, especially since the pandemic. But when we look at this year, we are seeing demand that's proving to be resilient, where we do see a lot of the estimates being revised upwards. And then obviously what non-OPEC produces is important for this number as well. And we do expect a significant increase this year, but we think that is going to be relatively slow. So when we look at just this year, I think we will need OPEC to produce a lot of oil, and perhaps more than what we were predicting earlier this year and last year. So that's my prediction for the year.
Thank you, Salih. We'll come back to you in a few minutes to talk a little bit deeper on the oil market. But first, we're going to go over to Patricio again. Patricio, I want you to talk about your prediction, which relates to the gas market and even has a tie-in to the focus idea that Will already told us about. So tell us your prediction for 2022.
Okay, so sure. Our call for 2022 is related to the storage levels for gas in Europe. So we've seen a declining trajectory in storage from the normal draws during the winter season, but storage levels remain below the historical norm. So as of today, the storage levels are about 38% full, which is still below the average of about 51% for this time of the year. So our prediction is that at the end of March, when the winter season ends, we'll see storage levels below their all-time lows, which are about 18%. And our call is for about 12% by the end of March, which would beat all other record lows, let's say. And this is on the back of two main assumptions. And this one is in the absence of a supply catalyst via the pending start of Nord Stream 2, which seems unlikely to come before the second half of the year. And well, also that may have been exacerbated by the Ukraine-Russia tensions, most likely. And the other one, the other big assumption is normal weather conditions. We've seen an improvement in storage levels and weaker draws over the past 3 weeks, and that's mainly due to two things. It's an increase in LNG inflows from the U.S., which we don't see as sustainable throughout the whole year, just given that this will rely on a revival of Asian demand. And the other main assumption is that we've seen is very mild weather conditions for the past a couple of weeks. So it's been a really mild weather. So I see those as the two main risks for our call. But there's although let's say beyond that, there's very little doubt that we'll be very near record lows, despite these two sort of catalysts that we're seeing.
Thank you, Patricio. I'll tell you about two that I contributed to the report real quickly. So the first one that I would draw your eyes to is the idea that European carbon allowances could have a higher average price this year than the price of Brent crude. So if you look at today's market, oil is at about $90 a barrel. European carbon allowances are at about 93 euros a ton, or about $105 a ton if you convert to dollars. And we expect this, or we think there is a decent chance that this relationship could hold, and we could see carbon remain higher than oil. Now, I realize that these are not exactly fungible goods. One way you could think about the price of carbon is that oil in most of the world is not subject to a carbon price at this point. If you were to imagine the oil market being subject to a carbon price of $100+ a ton, this would add about $40 a barrel to the cost of a consumer buying oil-related products right now. So right now, this is a sort of very theoretical calculation, but it's not theoretical here in Europe, and at least the refiners, as we've talked about before, are subject to this carbon price. So very interesting, something we're keeping an eye on. You can find our analysis and deeper thinking on that by visiting BI Go. The other idea that I talk about in our 2022 prediction note is our outlook that global solar installations will grow somewhere between 15 and 30% this year, according to our outlook. That would make it the fastest growing segment within the energy space. Last year, solar installations grew by a staggering 25% or thereabouts. The final count's not in, but it was a big increase, and we're seeing another bumper year. This is consistent with the IEA's net zero analysis, how quickly the industry is going. In fact, it's growing faster than IEA says it needs to grow to hit net zero. So very interesting component of the energy space to keep an eye on. Reach out if you want to talk more deeply on solar or the European carbon market. Happy to chat about that. So let's steer away from our 2022 predictions and get back into some very near-term things. Just earlier today, I think we got an OPEC agreement. So I want to come over to Salih Yilmaz, talk us through where OPEC's mind is at, and give us a lay of the land for the continued oil rally we've seen this year so far.
Sure. So, I mean, technically, the OPEC meeting is still ongoing, and that's why I'm kind of keeping an eye on the news wire and Twitter as well. But it looks like it will be a relatively quick, relatively boring meeting. I think every member nation seems to agree that they should stick to the original plan of 400,000 barrels per day of output hikes every month. I mean, this meeting is specifically for March, and it seems like what we will get for the month of March. But I would like to remind everyone, I mean, this is essentially the pledge that the group makes. But what's more important is how much they actually deliver, the actual output hike. And what we're seeing in the last few months is the actual hike that we're seeing in the market is much lower than this target number of 400,000 barrels per day. And we expect the same for February. And I mean, no matter what they agree on for March, we expect to see the same for March as well. And this is really because when we look at the OPEC and OPEC plus countries, it really does seem that it's only Saudi Arabia, the UAE, and maybe Iraq who is actually in a place to be comfortably producing more. Everywhere else, I mean, partly due to years of underinvestment and just we're seeing these countries really struggle to increase their output in line with these rising targets. So again, it's not irrelevant, of course, but it seems like we're not really going to get any surprises on what they agree on. But what we will continue to watch very closely is how much they actually deliver. And kind of, I mean, tying this back into what it means for the oil market is we know demand is strong. We know demand has been resilient even through the Omicron variant. And the first quarter is generally a seasonally not so strong quarter for oil demand. So we really were supposed to be building inventories, which we barely are. So looking forward into the second and third quarter, the summer months, when we know demand is going to be much stronger, and when we really are seeing OPEC struggling, I think we're looking at a potential deficit in the market, not a surplus, which is what many have been expecting. And I think it really does point to this Iran deal, the potential Iran nuclear deal that we've always been talking about, and it seems that may just be what the market needs to balance when we look closer to the middle of the year. And I think in terms of prices, it seems like we're getting a positive immediate reaction to OPEC kind of sticking to plan. But given the continued upbeat sentiment, given the kind of those many reasons on why investors tend to be bullish at the moment about the market, when we get perhaps closer to $100 a barrel, I think there will be more incentives and more reasons for parties involved to become perhaps more innovative and come up with some kind of solution, because I think it looks like the market will need those Iranian barrels later in the year.
Salih, what if we don't get those Iranian barrels? What is the short-run elasticity? I always think of oil as a relatively inelastic good, but are we getting to a price point where you're going to start to see consumers push back, consume a little less, consolidate trips to the grocery store, that kind of thing?
I think it's a good question, and I think eventually we will get to that demand destruction zone. But I mean, we are already at $90+ a barrel for Brent, and we still have refiners running at high throughput levels. We still have decent refining margins. So we're not really seeing that demand destruction just yet. I mean, it's at least it's not very clear. But yes, for sure. I mean, eventually, I think we will get there.
Okay. With the remainder of the time, I think we've got a few topics left that would be fun to tick through. So the first one is you've just laid out the kind of oil macro narrative, supply-demand balance, but obviously BI covers about 2,000 companies globally. This has read across into companies. You've put out a note just this week looking at the outlook for mid-size European integrateds that you cover, the OMVs of this world. So what kind of results are you expecting? And then we'll go to Will and get his take for the majors.
Sure. I mean, we're expecting a pretty strong fourth quarter for these companies, and I think we're getting an idea of how good cash flow generation might be for these companies from the likes of Exxon, because we know Exxon had a monster fourth quarter. We know Chevron also, Exxon was yesterday, but earlier as well, we know Chevron had perhaps not as strong, but a relatively good quarter as well. And this is really going back to how the benchmark prices have been very good for them. And demand has continued to improve, fuels demand has continued to improve from the very weak pandemic levels. So the refining side of things are looking perhaps not as good as the second and the third quarter, but still relatively strong. When we look at petchems, similarly, perhaps not as strong as the middle of last year, but still at healthy levels. So at every segment, we're really seeing support for and good contribution for these integrated. And when we look at the names that I cover in this peer group, are companies like Repsol, MOL, OMV, Gulf, and when we look at where they stand, their balance sheets are repaired. Financially, they're in a much better position now. They pretty much all of them have double-digit free cash flow yields. They have dividend yields between 4% and 5%. So they're doing quite good, obviously much better than the previous 2 years, and I think they're in a much better position now to consider potential dividend hikes and perhaps more shareholder returns as we look at 2022.
Thank you, Salih. Okay, over to you, Will. Give us the same perspective on European oil majors. What are you seeing as the earnings kick off with Shell tomorrow?
Yeah, it's a lot more of the same, to be perfectly honest. The conditions affecting the mid-size are very similar to the large European majors. The only thing I would add is that some of the European majors will be specifically benefiting from big value capture in 4Q from their gas trading and optimization units. So the Totals and the BPs and the Shells, leveraging their LNG exposure and gas integration to drive returns from the record benchmarks that we saw in Europe. But overall, it should be a very strong quarter. I wouldn't be surprised if we saw some record highs in earnings and adjusted cash flows from some of the companies. As Salih mentioned, the deleveraging milestones, which were the primary strategic objective through the pandemic, all of these have been achieved for all the Europeans. And so what this has done is it's opened the door to deployment of free cash flow. This is the big question now. How does that capital get allocated? And we are going to see buyback upgrades. I wouldn't be surprised if we saw some incremental dividend upgrades as well, although boards and management teams are being slightly more cautious on these. Both Shell and BP's dividends are still at roughly half of where they were at pre-pandemic levels. But the key question here is free cash flow deployment, and I think we're going to see that favored towards buybacks with a little bit of dividend as we're continuing to see quite a lot of capital discipline on the spending side, and with the exception of some transition-oriented M&A, which we've seen recently in offshore wind for Shell, BP, and others.
Thank you, Will. And Patricio, not to put you on a quick time slot, but I know we're about out of time, but give us a sense on what's going on with EDF. You've got a very interesting note about some of their recent troubles. Read the tea leaves for us and tell us about your outlook with the short amount of time we have.
Sure. So EDF had a pretty bad day a couple of weeks back when the French government announced it would cap tariff increases at 4% until 2023, and it would require EDF to sell an additional 20 terawatts to its rivals at discounted prices. So this resulted in an erosion of about 40% of the company's 2022 EBITDA consensus. And what we are arguing is that if the company can withstand these temporary pressures, the outlook on the other side of 2022 could improve significantly. But there's many moving parts as to why, and the main reason is that we expect the extended outages this year to be resolved. Although that's not 100% certain, we expect these to be resolved within the next 12 months. The other assumption is that the French government will ease back on these interventionist measures by 2023. So this will let the company improve its earnings profile with higher power prices that they've fetched from the power crisis we're seeing now. So a lot of the companies are hedging their forward sales at higher power prices, just trying to benefit from the turmoil going on at the wholesale market at this stage.
All right. Thank you, Patricio. That'll have to be the end for today. A reminder, we do these calls on the first and third Wednesday of every month. So the next one is going to be February 16th. In the meantime, you can find all of our research on BI Go. Feel free to shoot us an email or an IB to ask us questions. I want to thank you for your time, and I hope everyone has a great rest of their week.